Hello friends, there are 7 income streams worth over $500,000 combined that the IRS cannot legally touch in 2026. Most retirees can name exactly one of them. And stay with me until number 7, because that one puts actual rent checks in your pocket tax-free, and almost everyone gets it completely backwards. Number 1. Qualified Roth withdrawals. Every dollar you pull from a Roth IRA or Roth 401k is federally tax-free once you're 59 and a half, and the account has been open at least 5 years. Take out $20,000 or $60,000, the IRS gets zero. But here's what most retirees miss. Roth money is invisible income. It stays out of the formula that taxes your Social Security and out of the income number Medicare uses to set your premium surcharges. Pull $40,000 from a traditional IRA, and that withdrawal can drag up to 85% of your Social Security benefit into taxable income and push you over a Medicare IRMAA cliff at the same time. Pull the same $40,000 from a Roth, and neither thing happens. It never enters either calculation. The classic mistake is draining traditional accounts first to let the Roth grow, then wondering why the Medicare premium jumped and the benefit check got taxed. Often the smarter play is blending withdrawals from both buckets, so your taxable income stays under the thresholds every single year. One warning: each Roth conversion carries its own 5-year clock, and pulling converted dollars too early can trigger a 10% penalty even after 59 and a half. This week, find the date you opened your first Roth. If 5 years have passed, you're holding a fully tax-free bucket. Spend it strategically, not last. Number 2. The profit from selling your home. Under Section 121, the IRS lets you exclude up to $250,000 of gain on your primary home if you're single, and up to $500,000 if you're married filing jointly, as long as you owned and lived in the house for 2 of the last 5 years. Say you bought your home for $180,000 in the 90s and sell it for $600,000 this year. That's $420,000 in profit. And a married couple pays federal tax on none of it. Now the mistakes, because they're brutal. First, widows and widowers get the full $500,000 exclusion only if they sell within 2 years of their spouse's death. Wait until year 3, and the exclusion is cut in half. On a big gain, that single missed deadline can cost over $50,000 in tax. Second, moving into assisted living or a child's home and renting out the old house for years can break the 2 out of 5 years rule, and the exclusion quietly disappears. Third, people forget their real cost basis. That new roof, the remodeled kitchen, the addition, documented improvements raise your basis and shrink the taxable gain even further. A $40,000 kitchen remodel plus a $20,000 roof takes $60,000 straight off the taxable profit, but only if you can show the paperwork. This week, if a home sale is anywhere on your horizon, pull your original closing statement and start a simple list of every major improvement with rough dates and costs. Sellers who walk in with that list keep more money than sellers who guess. Number 3. Life insurance payouts and inheritances. The IRS says it plainly. Life insurance proceeds paid because the insured person died are not includable in gross income. A $250,000 death benefit lands in the beneficiary's account whole. No federal income tax, nothing to report. One caveat: if you leave the money parked with the insurance company and take it in installments, the interest it earns along the way is taxable. Inheritances work the same way. Receiving them is not income, and there's a bonus most families have never heard of: the step-up in basis. Inherited stock or property resets its cost basis to the value on the date of death. If your father bought shares for $50,000 and they're worth $300,000 when he passes, you can sell the next day and owe zero capital gains, $250,000 in growth, wiped clean. Here's the expensive mistake: parents adding an adult child to the house deed while they're alive. That's a gift, and a gift carries the parents' original low basis. The step-up is lost, and the child can inherit a tax bill of tens of thousands of dollars that a simple will or transfer on death deed would have erased. If you've retitled assets to keep things simple, have an advisor check it this week. That's 3 down. And remember, number 7 is still coming, the one where the IRS lets you cash rent checks and never report a dime of them. Number 4. HSA withdrawals for medical costs. Money coming out of a health savings account is tax-free at any age when it pays qualified medical expenses. And after 65, the definition gets generous. Your Medicare Part B premium, Part D premium, Medicare Advantage premium, dental work, hearing aids, glasses. All of it can be paid with HSA dollars the IRS never touches. And those withdrawals don't count toward the income number that sets your Medicare surcharges. A couple paying $4,000 a year in premiums from an HSA is moving $4,000 of spending completely outside the tax system. After 65, even non-medical withdrawals lose the 20% penalty. You'd just pay ordinary tax like a regular IRA. Two mistakes drain this account. First, contributing after you enroll in Medicare. Contributions must stop once Medicare starts, and it's especially dangerous if you claim Social Security after 65, because Part A enrollment gets backdated up to 6 months. Excess contributions in that window trigger a 6% excise tax until removed. Second, throwing away receipts. There is no deadline on reimbursing yourself. A knee surgery you paid out of pocket in 2020 can justify a tax-free withdrawal in 2026, but only if you kept the paperwork. Start a folder for every medical receipt this week. Each one is a future tax-free withdrawal. Number 5. Qualified charitable distributions. If you're 70 and a half or older, you can send up to $111,000 in 2026 straight from your IRA to charity, up from $108,000 last year, and it counts toward your required minimum distribution while never appearing in your income at all. That beats a normal donation because it works even if you take the standard deduction, and it keeps your adjusted gross income low, which protects your Social Security from taxation, keeps you under the Medicare surcharge cliffs, and preserves the senior deduction we'll hit in a moment. The mistake that costs people every December, taking the RMD in cash first, then writing checks to church or charity. Done that way, the whole RMD is taxable income, and most retirees get no deduction for the gifts. The money must travel directly from your IRA custodian to the charity, and it must happen before December 31st, before you've already withdrawn your full RMD for the year. Even $3,000 a year routed this way instead of donated from your checking account can shave hundreds off your tax bill. If you give to anyone at all, call your IRA custodian this week and ask for a QCD form. It's 1 page. Number 6. Social Security itself, when you keep it under the line. If your combined income stays below $25,000 single or $32,000 married, 0% of your benefit is taxed. Cross $34,000 single or $44,000 married, and up to 85% of it gets pulled in. Those thresholds were set in the 1980s and never adjusted. But 2026 hands you new armor. The $6,000 senior deduction for each person 65 and older, $12,000 for a couple, on top of the $200 standard deduction for married filers plus the existing senior add-on. Stack those, and a 65-plus couple can show well over $46,000 of income before federal tax touches a dollar, which is why most retirees living mainly on Social Security now owe nothing. The deduction phases out above $75,000 of income single, $150,000 married, and it expires after 2028. The mistake: one big traditional IRA withdrawal, say $30,000 for a new roof, spikes your combined income, drags your benefit into the 85% zone, and your real tax rate on that withdrawal can approach 40%, because every extra dollar you take out pulls up to 85 cents of Social Security into taxable income with it, so you're effectively taxed on $1.85 for every dollar spent. Split the same withdrawal across December and January, and much of that tax evaporates. Before any large withdrawal this year, run the numbers across 2 tax years first. And number 7, the one almost everyone gets backwards: you can rent out your own home completely tax-free. It's called the Augusta Rule, Section 288AG of the Tax Code, born in Augusta, Georgia, where homeowners rent their houses during Masters Week. Rent your home for 14 days or fewer in a year, and the IRS does not tax that income. You don't even report it. Charge $300 a night for 14 nights during a festival, a graduation weekend, or a big game nearby, and that's $200 tax-free every single year. Most retirees assume all rental income is taxable, so they either never try it or they list the house year-round and pay tax on every dollar. The 2 rules that keep it legal: never cross day 14, because on day 15 the entire amount becomes taxable, not just the extra day, and charge a reasonable market rate, which you prove by saving screenshots of what comparable homes nearby charge for the same dates. Keep a simple log of the dates and payments. 14 days, documented at market rate. That's the whole game. So look at the full picture. Roth withdrawals, home sale profits, life insurance and inheritances, HSA dollars, charitable transfers, Social Security under the line, and 14 days of rent. None of it is luck. Retirees who pay almost nothing planned it one move at a time. You are one step this week. Write down every income source you have, mark which of these 7 shields could cover it, and act on just one. Check your Roth clock, request that QCD form, or start the receipt folder. If this saved you even one surprise tax bill, subscribe and share it with someone you love.